Dear friends, welcome to September December 2020. This is the latest paper of SBR and I'm going to solve question 1 which is for 30 marks. So let us go to the requirement. As you can see, accusation. So this involves that some consolidation might be here. I'm just assuming because I haven't read the case study like you. As you can see, there are some asset acquisition and disposal also, and some group financial statements, usually consolidation, group financial statements, cash flows. All this type of question comes in your first question because this type of question can be asked in a lengthy way, right? More marks, it could be asked for more marks, like group financial statements, consolidations. It could be combined with joint venture, associates, all those things. So now let us read the requirements. Draft an explanatory note. Usually this type of requirements will come. Explanatory note to the directors of sugar company addressing how initial 40% investment in flour company and the additional purchase of the equity shares on 1st of July 2007 should be accounted for in the consolidated financial statements, including the statement of cash flows. So how the 40% investment in flour and the purchase of equity shares, how it will be accounted in the consolidated financial statements. Remember, separate financial statements, individual separate financial statements and consolidated financial statements are two different things. Okay, so using the goodwill figure they have given to you, so don't go to calculate the cash paid to acquire the control. Usually what happens is the cash paid, the consideration paid is given to you, then you calculate goodwill. But here goodwill is given to you, you have to find how much cash paid. So calculate the QA share to acquire the control of floor and include a brief explanation as to how that cash should be accounted for. So even that cash, how it will be accounted in the consolidated statement of cash flows, you have to tell. Brief explanation. Explanation is explanation, no calculation. 10 marks. You can see so much of things have been asked for 10 marks. So it's very important that you divide. It is not two marks for this, 2 marks for this. No, it's not equal most of the time. So you have to decide how much of marks. How will you know it? Look at your marking scheme. It's there. I haven't included the marking scheme here, but you do go and check. Part B, 16 marks. Prepare extracts of the cash flows generated from. Now this I say is like a what easiest question. It's like where you have to prepare extracts of cash flows generated from investing activities, financing activities in the consolidated statement of cash flows for Sugar Group for the year ended. No explanations are required in part B. Where they tell no explanations are required means no explanations are required. Don't try to put explanations thinking that you will get more marks because you are lacking calculations. That's a very wrong strategy. Don't do that. So this is a fully calculation part and your aim should be to get the full 16 marks. Make sure here they told investing and financing, they didn't told operating activities. So you have to be very careful that you don't go and include operating activities. It is not a full cash flow. It is extracts of cash flows. Understand that thing first. That's why I have underlined extracts. Part C, 4 marks. Describe the impact. Okay. Wherever this word impact comes, first of all is describe. That means you have to explain, write in words. Impact means you have to show the impact, effect of some changes before and after. That is the meaning of impact. What happens before and after you implement something, what is the impact? Has it have something improved or or it worst, right? The performance got worse. What is it? If any, sometimes there's no impact, but if there is any impact, describe it. That the defined pension benefit pension scheme will have another consolidated statement of cash flow. So here they're talking about what? Defined benefit pension scheme on consolidated statement of cash flows. Now you see how they are linking the two things. Statement of cash flows comes in IAS 7 and defined benefit pension scheme is under IAS 19. How they have linked the two? Right? So what is the impact of this on consolidated statement of cash flow? Definitely it will come in statement of cash flow. But what is the impact? for the sugar group for year ended 30th June 2008, assuming that the cash flows from operating activities are calculated by the indirect. Definitely, this comes in operating activities. Assuming that it is from operating activities and indirect method. Make sure that you know the direct and the indirect methods of operating activities. Even though you are not asked, you should know it. How it appears, what comes first, then what comes, right? Otherwise, you will not be able to deal with this question. Even though it's 4 marks, you will struggle a lot, trust me. Because I tell you, part B is 68 marks, but still it's easy to get the marks because there are so many places where you can get the marks. But part C, even if it's for 4 marks, it's easy for you to get 0. Very easy. Because you have to be very specific. So now let us start reading one by one. Now you have a choice, my dear friends. I haven't come to this topic before. In my previous paper, which I solved all the 4 questions, September, December 2019 it was. So this is 2020. You have an option. You want to do part A, part B, part C, whichever you want to do, you can do in any order. That's your choice because it's not linked. As you can see, pension scheme is the last paragraph. So reading it, you can answer part C or part B. If you want to answer, you need all this statement of financial position and all this information you need. Right? So we'll do both the method. I will show you both the method of doing. One, I will do in order. The other one, I will do in any order. Jumble up. But in this question, I will do in order. Okay. So first, I have read the requirements. Now I will read the background. As of 30th June 2007, Sugar has investments in several associate companies, including Flour. On 1st July 2007, Sugar acquired additional shares in Flour and obtained control. Obtained control means it's more than 50%. It's a subsidiary. That means consolidation, you have to consolidate. So the word control says it all. On 1st of October 2007, Sugar Company also acquired an associate. Clearly they have told associate. Even if they don't tell associate, if they tell they have a significant influence, they have acquired someone with significant influence, it should give you a hint that they're talking about associate. Right? That means more than 20%. So the group is preparing consolidate. That means associate you don't have to consolidate line by line. So the group is preparing consolidated statement of cash flows for the year ended. Acquisition of the Flour Company. Now let us read. A 40% shareholding in Flour was purchased several years ago at the cost of 10. Right? Now you're thinking that Flour is a subsidiary because they don't obtain control. How 40%? Because this is a step accusation. Step-by-step accusation. That means first you acquired 40%, later you acquired the remaining few percentage to get more than 50%, to get that control. Right? This type of question you have to be very well prepared for. A question which is very likely, I think around 80 to 85% has a chance of coming. This type of question has a chance of coming. 80 to 85%. So 40% shareholding at the cost of 10. Several years ago in the past, this investment gave Sugar significant influence. You see the wording, significant influence, not control. The consideration to acquire an additional 3 million shares. How much? Additional 3 million shares, 30% shareholding. That means now 40 plus 30 will give you what? 70%. Write it somewhere in case you forget it. In Flour on 1st of July was in 2 parts. The consideration. What is it? One is in cash. The other one is 1 for 2 share exchange when the market price of sugar was 6 each. In Flour, individual financial statements. The net assets had increased by now they are talking about individual financial statements. I told you consolidated group financial statements individual is different. This is only for Flour. Their financial statements, the net asset increased by this word to. By is very important. It increased to 12 million or it increased by 12 million. Makes a lot of difference. By 12 million between the two accusation dates. So the carrying amount of Flour net assets on 1st of July was at this one. So you have been given intangible assets, property, plant and equipment, cash, other net current assets and total net assets carrying amount. This is for flour. Now the carrying amount of the net assets at 1st of July were equal to the fair value except for land which had a fair value. So now they're telling land has a fair value of this much above the carrying amount. Above the carrying amount means more than carrying amount. What is the carrying amount of land? It is in property, plant and equipment. It is included here. No, I'm sorry, it's not there because they didn't say. I'm sorry, I thought it was land plan. It was property plan. So land had a above the carrying amount, more than carrying amount. The sugar group values NCI at a fair value. Very important. They value NCI at fair value. That means they will give you the fair value. So the share price of flour. What is the share price? Is this much. This share price would be used to value NCI at the date and to value the initial 40% equity interest. So this share price they have told will be used to value NCI at the date, and value the initial 40% equity interest in flour. Initial 40% equity means this 40% they are talking about. Initially they have acquired what, 40%, right? So that time that share price will be used. Goodwill at 1st of July was correctly calculated. That means there's nothing to do with adjustment of calculation. You have to find what, cash, and has been correctly accounted for in the consolidated. So even in the consolidated statement of financial position, goodwill is correctly shown. Okay. Now, asset acquisition and disposal. Including its purchase of additional investment in flour, which it currently consolidated from 1st of July 2007. The sugar also purchases various assets during the year. There were no disposals or impairments of intangible assets during the year, but amortization is there, had been deducted from profit from operations. Now, why they are giving this? You will understand it later. Because this is there usually to find cash flow from operating activities. That's why this amortization is there. The only addition to property, plant and equipment during the year were as a result of the acquisition of the flour. Okay, the group disposed of some property, plant at a loss on a disposal. So they disposed some plant and machinery at a loss on disposal of 2 million. Depreciation deduction from the depreciation is 10 million. Already deducted from operations. Sugar purchased a 25% equity interest in butter on 1st of October 2007 for 5 million cash, which gives significant influence. Butter paid a dividend in the post-acquisition period, and Sugar also received dividends from other associates during the year and 30th June 2008. Sugar did not pay any dividends during the year. There were no acquisition of investments measured at fair value through a profit or loss during the year, but there were disposals which had a carrying amount of 4 million. They were sold at a profit of 500, which were included alongside fair value gains in investment income in which investment income? In consolidated statement of profit or loss. The investment income figure also includes dividends received from these investments and any fair value gain or losses recognized on the initial investment. In addition to the shares issued to purchase, Sugar also issued ordinary shares for during the year ended. So it issued ordinary dollar share for cash. Sugar during the year 30th June 2008. They are giving all this figure for you to do the cash flow for under investing, operating and finance. Now, group financial extracts. The group's consolidated financial statements has been calculated correctly. Extracts together with relevant comparative figures as there. So you have been given the non-current assets, right? And you have been given the equity. Share premium is there. Non-controlling interest is there. Then consolidated statement of profit or loss. Now you have been given the pension scheme. So pension scheme I will read at the end when I do part C, because it is not relevant for my part A and B. So I'm not reading pension scheme now because I don't want to confuse you, right? Too much of information is not good. Overload of information is also not good. It will confuse you more and more. So forget about pension scheme. Let us read now. Now reread the requirements, you will understand better. Now you have initially you have taken 40% investment in flour, right? How that should be accounted in consolidated statement and also in cash flow, and also the goodwill. Using the goodwill, how much cash you pay to acquire the control, that means the remaining 30%, and also how that cash will be accounted in consolidated statement of cash flow. That is the part A requirement. So let us read part A. Cash paid to acquire. Now the accusation of flour is a step accusation. I told you, as I told. First you have to identify that this is a step accusation. There's not at once they are not acquiring 70%. First they're 40, then 30. So this means original 40% equity interest is treated as if it is disposed and then reacquired at fair value. Right? You're acquiring means what? Someone is selling to you, right? So that's a disposed. 40% you are giving up. When you're taking 30%, it means you're disposing 40% and reacquiring at fair value. That 40% equity interest. It is disposed and reacquired at fair value. This is how you measure what? Step accusation. When it comes for the original accusation. This rule is same. Whenever step accusation is there, the initial one will be treated as if it is disposed and reacquired at fair value. Now the difference between the carrying amount of the original 40% equity interest and its fair value would be calculated as a gain within P&L. Very important. The difference between carrying amount of original 40 and fair value is a gain within P&L. As an associate, the investment would have been accounted for using the equity. Now if it's an associate, there's an associate also. For that, how will you do it? It will be using equity method and would be valued at 14.8 on as at 1st of July 2000. How they got 14.8? The working is down there. So now first the cost, then the share of increase in net assets between acquisition dates. Add it, that will be your investment in associate. So first, what is it? You purchased at 10 million. Oh, highlight. 10 million is the cost. 40% you acquired. Right? 10 million is the cost. Now what is the fair value? It is 12 million because they told in individual financial the net asset had increased by 12 million between two acquisition dates. So 12 minus 10, take 40% of it, like how they have taken here. Sorry, I'm take 40% of 12, add it with the 10, the cost. Then that is the investment in associate 14.8 million. Now the fair value of the original 40 interest would be 15.2. You have to find the fair value also of this original 40% interest. Right? For associate you found no problem. Associate part is over. Now we are working for that step accusation. What is the fair value? Because we know the carrying value, but now we want to know the fair value. So how will you do the fair value? It is 15.2. How it is 15.2? Because you have acquired it at what? This is an investment in associate, not that associate which we are talking about. This is which associate? When you are taking 40%, isn't it an associate? Right? So for that initial 40%, that is an associate. You haven't acquired a control, that's why it's not a subsidiary yet. Right? So now fair value you have to find. So this is the carrying amount 14.8. You got the carrying amount. Now you want to find the fair value also. How will you find the fair value? Fair value is calculated as, what is it? The cost. 10 million when you acquired it. 40% initially you have acquired into 3.8 the share price, because they told the fair value would be at the share price, right? If you have forgotten, it's there. Where is it? Here somewhere it was given there. Yes, the share price would be used to value NS at the date and to wait, highlight, value the initial 40% equity interest. The share price is used, they told. It should be used to value NIC at that date, NIC at that date also, and also to value the initial 40% equity interest. That's why we are taking that 4.8%. I hope now you understand it better. So that's why you're multiplying here by 3.8 if you see, and you're getting 15.2 as a fair value. And so the gain of 400,000 would be included within P&L. How you are getting this gain? It is the difference between carrying amount and fair value. 15.2 minus the carrying amount, which is 14.8, which is 400,000. It's a gain, right? Fair value is more than the carrying amount. So this gain will be there in P&L. That also you have to write where the gain will go. Be very specific where each, calculate and then say where each item will go. You have to be very specific in this, especially in the consolidation part. Now comes the goodwill part, where we have to find the cash. So the goodwill will be calculated 1st of July, and that okay, the date that control is gained, right? You don't calculate goodwill when you're taking associate. You take goodwill when you acquire subsidiary. That means the day when the control is gained, you calculate goodwill. As the difference between the fair value of the consideration and the non-controlling interest. What is the formula for calculating goodwill? You should know, write it. You have to write it. It is the difference between fair value of consideration and NIC and the fair value of the identifiable net assets at acquisition. This is how you calculate goodwill. So the consideration must include the fair value of the original 40% equity interest as well as the fair value of the additional consideration. Understood? You have to write it in sentence, by the way, my dear friends. Have to write, then you have to do calculation. So the fair value of the NCI at 1st of July. How much you have acquired extra to get that control? Not 70%. After you got the control, that means 30, first 40, then 30, 70%. So the NIC will be the remaining 30% of the 10 million. That is the cost. And they have told to find the fair value at that date, 1st of July 2007, you have to use the share price. That's why multiplied by 3.8. So this is your fair value NIC. Fair value of the share exchange will be 9 million. How? You have acquired how many shares? 3 million shares. Remember, cash and consideration. Your consideration is made up of two things. Don't forget that. One is cash, one is 1 for 2 share. 1 for 2 shares means that's why you're multiplying by half. You have acquired 3 million shares. 3 million shares, please keep the case study in front of you. 3 million shares, half equals to 1 for 2 shares, and then into 6 share price. Just see here. Into 6 the sugar company shares, the market price. 1 for 2 share exchange. That's the reason. So it is 9 million. Because this also will go in your consideration, right? Consideration is not just cash, it comes as share also. That's why you have to calculate the fair value of the share exchange also. Now goodwill that has been determined as this much, right? Which means that the cash paid to acquire must be 3 million as follows, right? 3 million, that's what they have calculated. Let's see what they have calculated. Definitely you have to leave one line, do your calculation, then write how much is the cash. That also you can do, or first you do the calculation, then you write the sentence. The Based on this goodwill, this is the cash paid. That also you can do. So what is the fair value of the original? It had to follow this method. Okay, definitely the original 40% equity interest, the fair value just now you have calculated above 15.2. Fair value of share exchange just now 9 million. Add both. Then you have to add the NIC at acquisition fair value. All the fair value you have to add. The 40% equity interest, the share exchange, the NIC at acquisition. All these three fair values you have to add. Then you have to deduct fair value of identifiable net assets at acquisition. How will you do that? Here also you have to do a little working. 35,741 plus 600. 35,741. It is this fair value. Plus what? Plus 600. You have to add 600. Why? Because this 600. They told that land will exceed the carrying amount. That's why. So that land has not been there. That you have to add. You have to increase the fair value. So increase it. Deduct. Net asset at acquisition fair value will always be deducted. Then keep a line. The balancing figure will be your cash. Then comes your goodwill. So it is 3 million. 3,000 or 3 million because you're dropping down the 3 zeros. So cash paid to acquire flour will be included within where? That also you have to write because they told how this cash will be dealt in statement of consolidated cash flows. Where it will be included? Whenever you are paying cash to acquire a company or acquire an asset, it is always in the investing activities. This you have to be correct to get the 1 mark. Of the investing out of consolidated statement of cash flows. However, the cash held by flour will now be consolidated as a net outflow arises of this 3 million minus 1.234. This 3 million because they are paying for cash, it's an outflow. Minus this. It's an inflow. 1.234. Now how did we get that? You have to take your investment. Yes, this is the inflow, that is outflow, so that will be the total outflow. Now let's come to part B. Part B, if you say it is fully calculation, but it's very lengthy calculation, very lengthy. You have so much of working. You have until working 6. That shows the depth of this. So this, you have to write the for heading, extracts. If it's an extract of the consolidated statement of cash flow from the sugar group. Full, you have to write this as it is. Then don't start with operating activities. They don't extract. They clearly told you investing in financing, so start from investing and financing already. Cash flows from investing activities, cash flow from financing activities, workings. Working has to be separate. After this, two only workings. Okay. So starting with investing activities. Let's start. I'm going backwards. Meaning from here I will go backward and show you how we got this figure. You can work the other way also and see. From all those activities what will you go for investing. Usually that only we do. Because under the exam condition obviously we will not be having the marking scheme. For you to explain, I'm going backwards. Now the first item, look at under investing activity. Net cash paid on acquisition of flour. Just now we calculated it, 1766, this one. Right? It's a outflow. So it's in bracket. Done. Wherever it's done, I'm putting a tick mark. They have told also it's from part A. If it is like this, where you have calculated previously, don't recalculate it. Write in bracket like how they have written part A, part B, whatever it is, whatever part you have taken it from. Next, cash paid to acquire intangible asset. If you see here, it's working 1. And if you see the way they have done the working, they have shown it in that order and they have presented also in that order. Working 1, then it's working 2, then it's working 3, then it's working 4, then working 5, working 6. So before I go to the next, right, I can finish off an area where workings are not required. That also I can do. Let us go here. Cash paid on accusation of butler. Given in, so if something is given in question, you write it given in question like this in bracket. How much cash you are going to acquire for? Cash paid on accusation of butler. It's 5 million. Right? Here, I will put up 5 million cash. So this 5 million is outflow. I'm sorry. I will put it. It's an outflow. Next, proceeds from disposal of fair value through profit and loss investment. 4 plus 0.5. 4.5 is an inflow. Proceed. 4 million plus 0.5. So for this, here it is. This one. Through P&L during year disposal had a carrying amount of 4 million. This 4 and sold it at a profit. So this 500 will be added. Right? Because they told alongside fair value gains in investment income. So just add this to, no separate working. Just is the addition of this to and write it. Next. Rest all requires working. So I have to take you through working 1. Cash paid to acquire intangible asset. If you see working 1 is also long. So always start with brought forward balance 15,865. It is this 2007 15,865 and this will be the closing balance 33,456. Is it? Yes, this is the closing and this is the opening. Next. Six seven eight one license and patent 6781, this one. So here it will go as 6781 license and patents on accusation. This will be added and also goodwill on accusation. Because with intangibles, goodwill also comes. Goodwill is also an intangible only. So you will add that goodwill on accusation. You have just already it is calculated from the question. So you don't have to calculate it. Goodwill on accusation of sugar. When you acquire sugar only, you get this goodwill. It is already given to you 2,259,000. Then comes your amortization. Definitely intangibles are amortized. So amortization will be deducted 3.5 million or 3,500. Yeah, amortization is given here. This 3.5 million. Right? It will be deducted. So next comes the last one. The balancing is cash pay, because what you need in cash flow is only the cash amount only. That's why you're doing all this working. So cash purchase, whatever the remaining is, how much you used cash to purchase the intangible, the balancing figure is this. Because at the end you have to get this, right? Closing balance is given, opening balance is given, and adjustments is given. So it's easy for you to find the missing figure, which is cash purchase for intangibles, 12,059. So go and include it here. Cash purchase, that means you used cash to purchase intangible assets. That's why it's in bracket from working 1. Now let's go to working 2. It's proceed means inflow without bracket from disposal of property, plant and equipment. So let us go to working 2. Now you see how they have ordered it, numbered it and when they have presented also in that order, working 1, 2, 3 and 4. So property, plant and equipment brought forward from balance sheet, even the closing from the statement of financial position. Depreciation has been given. Carrying amount of disposal will be your balancing figure. Right? Acquisition at fair value 18,676. Right? This and this. This and this. So now here. Here this is 18,076. You have to, don't forget to add the 600 of land. That's why it is 18,676. Right? And depreciation, if you see, it is 10 million. Right? It was disposed at a loss of 2 million. So here 10 million depreciation also you have deducted. What the remaining is carrying amount of disposal, because the balance reduced at the end. So it is disposal. We know after you add all this figure, before you deduct carrying value of disposal, you know value reduced, that's why it's disposal. If value increased, then it would have been addition. So value disposed as a proceed. 6370. This will be added here. I'm sorry. Carrying value of disposal. Yeah, I'm sorry. One step I missed. See, this is what happens when you miss one step. Don't do this mistake. I did this mistake just now. Since the asset was sold at a loss, it was sold at a loss, right, of 2 million. So disposal proceed is 637 minus 2 because loss. So this is the cash. The proceed is 4370. Next is working 3. Dividend received from associates will come in investing activities because they have told it is in investing activities. Working 3. So investment in associate 23, 26. Opening and closing is easy. Here, this and this. From statement of financial position you take, then associates profit for the year 15,187. How will you get associates profit for the year? It is from here 15,187. So that profit also you take. After that, acquisition of butter, how much you have acquired it for 5 million. Butter is a associate only. Add it. Step acquisition. Sugar. Why step acquisition you have to deduct? Because when you have acquired sugar for the first time, 40% it was an associate. That's why it has to be deducted for 14.8. From part A. Not after the remaining 30%, but the first 40% initially. Then the balance is your dividend received, which is 2253. So dividend received, so it will be added. Next is working for. Investment income received. Obviously, it will be in investing activities, only working for. So fair value recognized in investment income. First, it is 6, then it is 3 million. Right? Check here. 3 and 6. Opening is 6, then is 3. Financial assessment should add fair value to this one. So it is 6 and 3. What is the carrying amount of disposal? You have disposed it for 4 million. The balance is 1 million, which is fair value gain. Right? Carrying amount is 4 million because disposal. The carrying amount of 4 million. Right? Fair value to this one. For that item. So the remaining is fair value gain, but that fair value gain, first investment income per P&L, it is 3891. This is investment income. If you see here, the investment income is this 3891 per P&L. With that, you are deducting this fair value gain on this investment 1 million. After that, fair value gain on step acquisition also you are deducting. We just calculated this from part A, it was 400. Next, profit on disposal is also 500. So whatever it is, that is an investment income received is this much. $1991, which is deducted here. Added here, I'm sorry. Then comes to issue of ordinary shares and dividends paid to NIC are financing activities. Working 5 and 6. Tutorial note and all will read later. So here 20 million from share capital and share premium from statement of financial position only. We are taking opening and closing balance. Share for share exchange in part A 9 million. We have just calculated in part A. We are adding it. That means we are getting 9 million shares. Next, share proceed from issue of shares. The balance is the share proceed from issue of shares 9.6. So we are adding 9.6 here. Next is dividends from paid to NIC. Working 6. So NIC brought forward, NIC closing. Right? If you see here. Next. We have been given NIC for the year and added on acquisition. So when you have acquired, this was the fair value of NIC. You have got 11.4. Next, NIC for the year is 9162. Profit for the year, NIC's profit for the year 9162. Profit for the year will get under profit. This one. You see, so much of things is to do. From here we have to take from there. That's why you have to practice until you are very quick in finding from where exactly you have to take the information. Otherwise, this becomes a very time-consuming process. So 9162. After that, the balancing is dividend paid to NIC. This one 3324. You go and deduct it here from financing activities. So if you can see, working 1, 2, 3, 4 is done. Under 4, there is an issue note, tutorial note. So proceeds from the disposal of this one or this one, 4 million plus 0.5. The fair value gain is included within investment income, but which is not a cash flow. You see, it is not a cash flow fair value gain. And so will be excluded from consolidated statement of cash flow. In addition, there is a 400,000 gain. Yeah, the fair value gain, right? There's a fair value gain arising from a step acquisition income within investment, but it is in a cash flow. The profit of disposal is also not a cash flow, but forms part of process from the disposal of this one within investing. Cash process included within investment of the group are there for this much. So they're explaining why they have included fair value gain, because it's not a cash flow. But in this they have included, why they have included, that is under tutorial note. So read it. Now we are done with part B also. So what's remaining is part C, which we didn't read the case study also. Part C is for pension scheme, IS 19. Sugar Company is the only entity of the group which operates a defined benefit pension scheme. The pension scheme obligated increased during the year from this to this. Okay, obligation. The movement on the pension liability represents the service cost component, net interest component, and also the remeasurement component for the year. Sugar also makes cash contributions into scheme on the annual basis towards the year, and the significant increase in pension scheme obligation for the year ended because the contributions to the scheme did not follow normal practice and were instead made on 1st of July 2008. Benefits paid during the year were 2 million in cash. So now you have to answer C. What is the impact of that on the statement of cash flows, and also assuming cash flows are from operating activities? 4 marks. So the old cash flow that should be recorded in the statement, consolidated statement of cash flows in relation to a defined benefit pension scheme are in the contributions paid to the scheme. You see, contributions paid to the scheme only have to be there because that is the cash. They are typically included within operating activities of the group statement of cash flows. Since Sugar did not make any contributions until after the year end, there will be no cash flows to include in the consolidated statement of cash flows for the year ended. You see, there will be no cash flow for the year ended. Why? Because they haven't made any contributions until the year end. That's why. So the 2 million benefits paid out of the scheme are a cash outflow. It's a cash outflow, right? The 2 million benefit is paid out of the scheme only. But they are an outflow of the cash from the pension scheme itself, a separate entity rather than a cash flow of Sugar. This does not mean that the pension scheme will not have an impact upon consolidated statement of cash flows of the Sugar. Since operating activities are they being calculated using indirect, it is necessary to adjust for any items that affect operating profit but not cash flow. You see, it is an indirect method. That's why you have to adjust for effect operating activity but not cash flow. This would include the service cost component. Yes, in the operating activity, what comes when you adjust operating profit? Service cost component, which would need to be added back to get the cash flows. What do you have to do? Service cost component was deducted to get profit. Now to get cash, you have to add it back to the group profit. Care would also need to be taken in calculating interest paid in the year. Yes, interest is another component. The finance cost charge. Interest is the finance cost charge only. In the P&L would include the net interest charge from unwinding the opening value of the liabilities and estimated return on assets. Neither of these are cash flow, and so would require adjusting. Yes, you have to adjust it because it's not cash flow. So the remeasurement component is included as part of other comprehensive income. Yes, when something is remeasured. Remember this under IAS 19. It is included in where not in P&L, other comprehensive income, and will not impact on the group statement of cash flow. Other comprehensive income, it will not have an impact on groups. You have to clearly write when something does not have an impact, right? Will not impact on group statement of cash flow. Since it is not a cash flow. Why? It's not a cash flow. Nor does it impact upon operating profit because it is under other comprehensive income, right? So that's it for question 1. Hope you like this video and it helped you a lot. Please do comment me if you have any more queries and if you want me to solve any particular past paper, because I'll be solving all the SBR paper. That's what my students requested me to do and I will do it for them. And next I'll be coming to question 2, 3 and 4 of the same paper. Till then, take care. God bless you.